Did you know that 90% of traders lose money trading the financial markets? Within this video, I'm going to break down a trend following system that incorporates daily fair value gaps in confluence with our order blocks. Okay, so this is a trend following system. We use the daily fair value gaps in order to gauge trend direction, and then we use order blocks in order to look for a pinpoint entry on our lower time frame. So without any further ado, let's just jump straight in and let show you guys an extremely profitable strategy. Okay, so what you can see here, this is on the daily time frame. Okay, we have a daily fair value gap. Okay, essentially what that is a gap in momentum between the last three candles. So you can see you've got this high here, and you've got this high here, and then you've got the low of this candle here. Okay, so there's no overlap between these candles here. Okay, what you're best off probably doing is heading over here and typing in, so indicators tab at the top. If you type in fair value gap from nephew_Sam, add that to your chart, that'll automatically plot them for you. Okay, one other thing to note for this is, ensure that you tick this box here, which is to wait for candle close to identify the fair value gap. So this is very, very important. It means that you're not getting any false triggers. It's only identifying the actual fair value gaps once the candles are confirmed. Okay, so now that we've identified our daily fair value gap, what we can do is pop onto the lower time frame. Okay, so essentially this daily fair value gap signifies to us that the momentum is pushing to the upside. Therefore, we're looking for trend continuation plays only to the upside. All right, so let's jump down to the 4-hour time frame here. And what you can see is our daily fair value gap, and ultimately price moved very, very impulsively to the upside, leaving this fair value gap. Okay, so we understand that our thesis on this market is certainly bullish. Now we need to look for a pinpoint entry using our order blocks. Okay, so an order block is essentially just the area where price reacted from before the impulsive movement. So essentially the last down movement before the impulsive movement. Okay, so clearly we can see here, let's zoom in for you guys. So this is a 4-hour time frame. This is our lower time frame for entry. You can see this candle here. So we had a wick to the downside before the impulsive move to the upside. So for example, if we drop to the hourly, you can see this is this area here. So essentially it's this down move here. We had this sort of correction before the extremely impulsive move to the upside. Okay, so this is our order block here, and basically a wick on the 4-hour time frame will be essentially a lower time frame order block, so like an hourly order block. Okay, so this is our order block here. Let's mark that on. So that's a 4-hour order block. Okay, and what you can see is these orders were collected and then price impulsively moved to the upside. So in terms of an entry, you want to enter at the convergence, so the intersection between our order block and the daily fair value gap. And that sounds quite complicated. However, it is very, very simple. So all that I basically mean is that you enter on the intersection of the daily fair value gap and the 4-hour order block. So that's this area here. This is the sort of lighter area. This is the intersection. Okay, so that's this area here. You only want to enter, you want to enter from that area, and then you've got clear invalidation. Okay, so we're going to enter a limit order long from that area. Stop loss, we want to give it a little bit of room to breathe. Okay, you've got a sort of an area here. We could put our stop loss just below the candle, the order block. However, I think it's very important to have a bit of a wider stop in order to allow your thesis to play out and be very, very patient within the markets. Okay, so, often traders find, that they might understand trend direction, but they may have the stop loss may be too tight, and then volatility actually takes them out the markets. Okay, so give it some room to breathe, allow your thesis to play out. You don't want to, you're never going to be able to time the bottom absolutely perfectly. Neither are you going to be able to time the top for your exit absolutely perfectly. So let's see if we get triggered in this trade. And you can see we're triggered right here. So price comes down into the intersection there. We're triggered long in this market. We've got stop loss at 20 pips, and we're going to look to take profit up at the high. So in terms of a logical take profit, you've got this daily high area coming in here at 1.08, This is a 1 to 4 risk to reward. So that's very, very great in terms of a risk to reward. Okay, most of the position will be coming off at around a 1 to 1.5, 1 to 2, and then some of the position will be left on to run up to the daily highs if we do get there. Okay, so that's mapped out. Let's allow that to play on now. Okay, and you can see our 1 to 4 risk to reward was hit on this trade. Okay, so that is how you couple the daily time frame using daily fair value gaps for your bias, and then looking for a 4-hour order block and ensuring that's within the intersection within the daily fair value gap, and in order to give you a very, very consistent and quantifiable trade. Okay, so that's it for this one, and I'll see you next time. Take care. Bye-bye.